So I'm going to get started because it's 8 o'clock, and then Emily will let people in as they come. So I want to start first saying welcome. I am Peg Keogh, and I want to start with a story. So I was laying in bed one night, and my kids were downstairs. And at the time, they were seniors in high school. They're twins. And they were watching TV and just laughing and having a good old time. And I sat up and I realized that I was sobbing. And I turned to my husband, who was actually kind of surprised because I'm not a crier. And I said to him, I'm not going to hear this laughter next year when Shannon and Brennan go off to college. And I remember that feeling that I had, and it was years ago, like it was yesterday. And so I share this because I think this is where a lot of you are. If you have a senior or a junior, or even a sophomore, you're in this chapter where it's a really fun chapter, but it's this perfect storm of emotions. As a parent, this is really what you've been doing for all these years to get them ready to take this partial step to be on their own and go off to college. And so it's exciting, but at the same time, it's kind of melancholy because this chapter with your kids is coming to an end. And then for the kids, most kids are just like, oh, I get to be on my own. I get to make all my own decisions, do whatever I want. And that's exciting. But again, it's a little scary. Even if a kid doesn't admit it, all kids are it's a little scary, right? So it's this perfect storm of emotions. And so I just here to tell you that I get it. You'll get through it. Take a lot of deep breaths and try and enjoy it. And hopefully my presentation tonight will alleviate some of the stress around the financial piece and will get you starting to understand this. So that will give you a little peace of mind and help you see next steps to keep your planning going. So basically, when my kids hit high school, my husband Bill and I, we like, oh, they're in high school. We got to do this deep dive. We got to get into this college stuff. And we realized probably what most of you have realized if you've done anything around this, that it's much more complicated now than it was when we were kids. And the other thing I realized is that a lot of my friends and colleagues were not doing a deep dive. Yeah, make sure you mute yourself. Thanks. They weren't doing a deep dive and they were kind of drifting through this process, which created a lot of confusion and a lot of stress. And I had this aha moment where at the time I was doing financial planning. I had been doing it for about a decade. And I thought to myself, if I coupled that expertise with this deep expertise in college financial planning that I had developed through working with my kids, I could impact families even more. And I saw such a need for that. And so that's what I did. In 2014, I started my own business called Way to the Quad. And since then, I've helped hundreds and hundreds of families navigate this process. Basically, I work with parents of college-bound kids who have college-bound kids who struggle with how to pay for college, and who wouldn't struggle with price tags of $80,000 and $85,000 being the most expensive schools now. And I help you navigate by teaching you about financial aid, and then even more importantly, helping you understand where you fit, because that's really the name of the game, is understanding where you fit and how college is priced. And that's what we're going to talk about tonight. So let me share my screen. And a quick visual of my family. My kids look a lot different now, but that's when they were seniors. A couple of my canine kids. You'll see some more dogs in this presentation as well. Okay, so there are 3 types of fit. This is what I tell my families. There's academic, personal, and financial fit. And tonight we're talking all about financial. So kudos to you for jumping on this breakout session and realizing this is important, because really all 3 of these should be looked at together when you're guiding your child and building a college list. So I mentioned, maybe I didn't mention this one, but as I worked through with my kids, I developed a process, and I call it Journey to College Made Easy. And so tonight I'm going to give you a high-level overview of this process. I'm going to teach you bits and pieces of it in the next 25 minutes to hopefully get you on your way. This is a process that you're all going to go through. If you're a senior parent, you're already in this process. If you're a junior, you're right up on it. And sophomores, everybody goes through this. So the first step is what I call pay less for college. So let's jump in. I want to encourage you to believe me when I tell you it's a buyer's market. And you might think that's a crazy statement because we all know about the colleges that accept 5% of kids and they're in the driver's seat and they're pretty much rejecting most of the kids that apply. Well, that's not the norm. Most colleges in this country are trying to fill their seats. They're great institutions, could be a wonderful academic and personal fit for your kids. And you are in the driver's seat in a way. And so I don't want you to worry about these sticker prices. And I'm going to show you why. Here's an example of a student that I worked with a couple years ago. So this student got into a public school, happened to be UW, and a private school, Gonzaga. So if you look at those sticker prices, 27,000, and 51,000, it would be very easy to look at that and say, well, 100,000 versus 200,000. We can't afford either one of those. So the 200,000, no, we're not even going to let you look at that school. Well, this child obviously applied to both and got a financial aid award. And this is what it was. This family had an expected family contribution, and we're going to talk about that in a minute, of $21,500. The package that this student got, this is an actual student, at the end of the day, what the public school was asking them to pay was $27,000, no different. The student was awarded loans, no grants, no free money, no gift aid is what I call it. But the private school, on the other hand, reduced that almost $51,000 down to $30,275. And there's no loans included in that number. Loans would be offered on top of that. So that's a really different conversation to have, right? That's a $3,000 difference. So I really encourage you to not be worried about these high sticker prices. You're going to do your homework and you're going to know what kind of schools those are. And that's what I'm going to teach you tonight so that you'll know what questions to ask and you'll know what to do to figure out what the discounts are going to be. Okay. So obviously Gonzaga seriously discounted their sticker price for this student. Okay. So what's going on with this discounting? This was a study over a decade, 2008 to 2018. And you see tuition and fees went up almost 47% in that time frame. But the discounts, meaning this is the money that colleges gave from their endowment to students, went up by 91%, much more than the tuition. You hear about, oh, the cost of school has gone out the wazoo. Nobody talks about the discounting that's happening and that it's much rapider, right? I don't think that's a word. It's much greater. So really the net is 18%. Okay. So what you want to understand is how are they discounting and how can I get these discounts? I know every parent who's listening to me does not want to pay full price for college. Okay. So how are they doing this? They're doing this in one of two ways. They're offering need-based / self-help aid. So this is grants, work study, and loans, okay? You have to have financial need to get this form of aid. Somebody needs to mute themselves. Okay. The other way they're doing it is with merit aid. Merit aid is non-need-based aid. So it's grades, test scores, athletics, talent, right? So Bill Gates's kids can get merit aid. And some schools do a combination, right? So this is how they're discounting. So let's talk about need-based aid first. There's a very simple equation that they use. They take their cost of attendance, which we'll talk about, minus this EFC, they get your financial need. So if the school costs $60,000 and you have an EFC of $80,000, you don't have any financial need at that school, right? If you have an EFC of $40,000 and the school costs $30,000, you're looking at like a UW costs $27,000. You don't have any need-based eligibility at UW. But if your child looks at a school that costs $70,000 and you have a $40,000 EFC, you now have financial need. So it's dependent on the school and what the school costs, okay? So cost of attendance, tuition and fees, room and board, books, and schools always have one or two line items for transportation and personal expenses. So when you hear the term cost of attendance, this is the whole enchilada, all of this. When people talk about tuition and fees, that's only a portion of this, right? Room and board, can be, it is over $10,000 at most schools in the country, right? So there's a lot more that goes into it. So if somebody's quoting you tuition and fees, you need to say, you know, a school, you need to say, hey, I want to know your cost of attendance. I want the room and board and the books in there, because that's what you're going to be paying, okay? Okay, so EFC, expected family contribution. This is the minimum annual, and I'll say that again, minimum annual amount that the colleges think you can afford to pay for 1 year of school, hence the annual, right? There's 3 different methodologies. We're going to touch on 2 of them tonight. I've been doing this for 7 years, and I've never had a parent, when we look at the 3 estimates of their EFCs, that's what I do with families, that looked at them and said, oh, yep, I'm good, Peg. I can cover that. Most people are shocked at how high those numbers are. Most people are looking up in the sky, and I have to tell them, no, 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 don't divide this by 4, multiply it by 4. So realize, and I'm going to give you an inkling of how they calculate this, and it'll make a little bit more sense to you. Also realize this isn't the only amount that you might be expected to pay. A lot of schools, you have an EFC, but they don't meet 100% of your need. Most schools can't afford it. So there could be more on top of the EFC that you're going to be expected to cover. Okay, so just realize that. That's called gapping. Okay, so what are the main drivers in this equation? By far, the biggest driver is parental income. They take out what you're paying in federal income tax. They know you're paying Social Security and Medicare. They have an income protection allowance. They take some things out, so they don't assess your gross, but then they assess whatever's left. And it's like the tax tables. The bottom part of what you make is assessed at a lower rate, 22%, and then it goes up to 47%. So if you make a nice living, the higher part of your income is going to be assessed at 47%. So it's a big driver. They also look at non-retirement assets. That's up to 5.64%. So not nearly as high, but anything that's not in a retirement account is part of the calculation. So 401ks, 403bs, IRAs, those are all retirement. So those are not included. If your child has income or assets, that's a big driver, but for most kids, they don't, right? They're assessed, kids' assets are assessed 20 to 25%. But again, most kids don't have assets in their name. But if they do, that can be a big part of this. Voluntary pre-tax retirement contribution. So this is a financial aid world thing. If you're saving for retirement, which you should be, it's a wonderful thing, yay. Most people do it pre-tax. So it goes right out of your pay, your gross into your 401k or 403b. Well, colleges look at that, and if it's not mandated by your employer, so for example, if you work at UW, you are required to save. So if it's mandated, it's not, you're not part of this. But if you're voluntarily saving, which is the norm, whatever you save pre-tax gets added back in. And the colleges view this as mom and dad don't have to save for college. Colleges don't care if and when you retire. They just care about putting a shiny 1 year package in front of you and your child. Okay. So realize that. So if you make 150 and you save 20,000 pre-tax, they're going to look at that as 170. Okay. And then crossover years. If you have more than one child in school up through the next 2 school years through 2022, 2023, and I'll talk about that in a little bit, your EFC can go down 30 to 50%, depending on the school and how they calculate the EFC. So that can be a big deal. You could have an EFC of 80,000 and really have no need-based eligibility, or 90,000. And then all of a sudden, with 2 in school, it's 45,000 and the school costs 80. So that's a planning opportunity for the next 2 years for sure. Okay, now let's talk about step 2, forms and figures, financial aid forms. So let's talk about the Fafsa. Probably a lot of you have heard of this form, the Free Application for Federal Student Aid. Every school in the country requires this form. I strongly encourage you to submit it, okay? We're not going to get into the details of why. I have many reasons, but we don't have time. Just submit it. The key highlights here. They don't look at your retirement accounts, which I mentioned before. If you own your home, they don't look at your equity, meaning the market value minus any liability. If you don't have a mortgage worth $1 million, that's your equity, right? If you are a business owner and it's a family-owned business with less than 100 full-time employees, they don't look at the value of your business. That's not part of it. Any income your business creates goes on your tax return. That's part of the income part of the calculation, but the value of your business is not included as long as it falls into that category. Okay. This is a big deal on the FAFSA for the next 2 years. If you are divorced or separated, the FAFSA only requires the custodial parent to provide financial information. And the custodial parent is defined as the parent that the child lives with the most time. When you do a year look back from when you submitted the financial aid form, when you hit submit, look back a year. So this is a great planning opportunity for families that have 50-50 custody, because there's 365 days in the year. So your child can spend a little bit more time with one of you, and you could make it the parent that makes sense. This is good for another couple years, and then it's going to change. So this is a big planning opportunity for these type of families. It can make a dramatic difference in EFC, okay? So anytime, I told you there would be more dogs, anytime there's a big planning opportunity, big dog slide. I have big dogs. This is one of my dogs who's now gone, Sal, but who doesn't want to look at a cute dog during a financial presentation? And it is a big, big planning opportunity. Okay. The second form that some schools require is called the Css Profile. This is administered by College Board. So this is the nonprofit that does the PSAT and the SAT. Just a minute. Throat's a little dry. And APs. So I'm sure most of your kids, if not all of them, have credentials, login credentials. So that's how you access this form. Less than 300 colleges require this form in addition to the FAFSA. It doesn't replace the FAFSA. Every school needs to get the FAFSA. These are mostly private schools. There's a few publics, UNC, Chapel Hill, UVA, Michigan, William and Mary, off the top of my head, but most of them are private, okay? So you need to submit both forms if you want to get awarded their endowment money for need-based aid. The key differences between this form and the FAFSA that make a big difference for a lot of families are, one, most of these colleges look at your primary home equity, the home you live in. They look at it in varying amounts, and some of them, like Whitman in our state, they don't look at it at all. It's just their philosophy. And there are other colleges that don't as well. So that's a planning opportunity for your family if your child's looking at profile schools and you have a lot of home equity. They more often than not look at both parents, both biological parents. So some schools don't, but most of them do. So you want to understand that. And then businesses are always on the table. They ask if you have 5 businesses, you're going to be answering questions about all 5, and they're going to dig into them, and they're going to include them in their analysis of what their EFC is. They number crunch and they create a second EFC. And if that's higher, they will use it in that cost of attendance minus EFC for financial need. So you might have financial need through the FAFSA calculation, but maybe not. It's called the institutional calculation, which comes from the Css Profile. So as I've said, are all the colleges the same? No, they are not. That just would be way too easy. This whole process is needlessly complex, which is honestly why I have a business, to help families with this. So that's another planning opportunity, FAFSA school versus Css Profile school. It doesn't mean that Css Profile schools are bad, but you should go in with your eyes wide open. One of the people in the chat from the last session said, great presentation, eye-opening. That's what I want. I want to open your eyes. I want to educate you guys, because the more you understand this, the better you're going to get discounts, and you're not going to end up leveraging your retirement to pay for college. So how does this work? You're going to submit that FAFSA your child's senior year, and they're going to ask about your income. It's a 2-year look back. It's called prior year. President Obama put it into place. So if your child is going to college in 2022, this is the easiest way to remember it. Just take that year and subtract 2, and that's the tax year that you're going to be asked about. You don't have to memorize this because it will be very clear on the financial aid form. But so if you have a junior, your first FAFSA will be 2020, then 2021, 2022, and 2023. So basically, if you're listening and you have a sophomore, you are in the tax year right now that you are going to be answering questions about when your child's a senior. So most parents are not thinking about this right now. But just the fact that you know that is huge, because you can avoid creating capital gains and other income that you don't need to create. Obviously, you have income from your job and you're not going to quit your job. But I see people all the time who creates income that they wish they hadn't if they had known this. They had known about prior year. Assets, on the other hand, are literally the day you hit submit. So very current for asset value and 2-year look back for income. The forms go live October 1 of your child's senior year. You can't fill them out before that, okay? Fafsa is always October 1. CSS the last couple years has gone a little earlier than that. Okay, another planning opportunity, understanding that prior year, okay? All right, so now let's talk about the second way that colleges discount, which is through merit aid. So some people, this is the name of the game for discounts. If your EFC is 150,000, you're not going to get need-based aid, right? Thank God there's no schools that cost that. Over 50% of my clients don't have need-based aid. That doesn't mean that there's nothing to plan. You still have to think about this so that you can leverage these discounts that are out there. So let's talk about merit aid. It's offered by the Office of Admissions, not financial aid, right? So your child applies and they get it. They want that child. They want your child. So they say, we're going to accept Emily, and congratulations, Emily, you got in and you're getting a $20,000 Provost scholarship, $80,000 off the cost of college. So basically, they have no idea about your finances. Office of Admissions wants your child and is immediately starting that discounting process. Okay. They don't know if you can afford to pay for school. And if your EFC is 150,000, they're not going to take this merit aid back. They're already discounting because they want your child. They might not give merit to another kid, but they'll let the kid in because, yeah, well, this kid will be successful, but we don't want to entice him. We want to spend our money to entice other candidates. So that's what merit aid truly is. It's usually based on grades and test scores. With test optional, the schools, many of them have shifted and have more focus on the grades and rigor of curriculum. But that's typically in a regular year, that's typically how it's done. And they have different awarding methodologies. They don't all package merit the same way. They have automatic scholarships and competitive. We don't have time to get into the nitty-gritty of that, but just realize, just like everything else in this process, it's different from school to school. So understanding that is going to be an important thing for your planning, okay? So let's talk about this, merit aid versus need-based aid. So some schools are known for being very good at offering merit aid. And the schools you see on the left here, these are a few of those schools, right? So, and when I say they're good at awarding merit, I'm talking about 10,000. I mean, I've seen lower than 10,000, but 10,000, the highest award I've seen of a scholarship that you don't have to apply merit, that you don't have to apply for extra, with an interview or an extra essay, was $35,000. Granted, that's not the norm, but there's a few schools that I know that do that, right? That's a huge discount. $10,000 is a $40,000 discount. In my book, that's a lot of money, right? So there's schools that are known for that. On the flip side, there's schools that are really good at meeting need. So I will tell you that very selective colleges, the Ivies, the Stanfords, the MITs of the world, they are excellent at meeting financial need. 100% every year, no questions asked, right? If they calculate that you have need. But they don't offer merit, right? They don't need to entice a kid with perfect SATs and a great GPA because they're already applying, right? They have their pick of those kids. So this is an important thing for you to understand. If you do some analysis and you realize that you're a merit-based family discount, that's where you're going to get your discounts. If you stack up a list of all the Ivies, that's fine, but do it with your eyes wide open, knowing that you are not going to get any endowment money from those colleges. So you're going to be writing a full check, or you're going to be finding money elsewhere. Now, I'm not trying to make the point here that either colleges offer merit or need, because there's plenty of schools that offer both. Most schools offer both, right? Some just don't offer any merit. And all schools meet need at a certain percentage, but it could be low or it could be, 90%. It just depends. Most schools can't afford 100% because you have to have a pretty big endowment to support that. Okay. So that's another planning opportunity. Understanding what type of school you're looking at. First, what your family is, and then you look at schools. Well, these kind of schools are going to be cheaper than these schools because we're going to get some discounts at these schools and we're not here. So then you mesh that with the academic and personal fit. Okay. This step, I'm not going to go into detail. This is a webinar in and of itself, but this is the most fun step, I think. It's when your child is getting in. So they're super excited. It's a really fun time, right? So you get financial aid award letters that are all different. You have to analyze them and you have to decide, should we reach out to the schools, right? So that's that whole process of appealing. And I just want to say, yes, you can appeal. Some parents just don't realize they can appeal. So that's all I'm going to say on that. You want to do analysis of the award letters and make sure you understand them because they can be confusing. And then if it makes sense to appeal, you want to appeal. There's a right and wrong way to appeal. You don't negotiate. You're not buying a car. And if you approach the college that way, you're not going to help you. Okay. So that's that step. The last step, your adventure awaits. This is when you're bringing it all together. So I want to take a minute because student loans are such a big deal right now, right? It's over $1.5 trillion. There's so much stress and angst around this, and Biden might forgive some of the loans and yada, yada, right? So I want to talk about, to me, this is the only loan out there that is truly a student loan because your child will be eligible for this loan as long as you submit the Fafsa. It's called a direct student loan. Stafford is what it used to be called, so you might still see that word. And there's two types. There's a subsidized, and that's if you have financial need. So the government pays the interest until 6 months after you graduate. There's an unsubsidized that is the same loan. The interest starts accruing. You don't have financial need, but your child can still get the award. If you have need, the numbers over here on the left are the maximum subsidized loans you can get per year. So that totals $19,000. They'll always give you an extra $2,000 of subsidized. So if you have no need, you're going to get $27,000 of an unsubsidized loan, $5,500, $65,000, and so forth. If you have need freshman year, you're going to get $3,500 of subsidized and $2,000 of unsubsidized. These are use it or lose it. So you need to do a 4-year cash flow. And I'm going to show you that next. Really, really encourage you to view this purchase in a 4-year cash flow because it's a 4-year expense, right? The interest rate this year, and this can change every year, it's linked to the 10-year Treasury note, is 2.75%. It's a screaming deal. Interest rates are super low with what's going on in our economy and the Federal Reserve. I don't look for it to go up too much, but it's fixed for the life that your child gets that loan freshman year, and it's 2.75 for the life of the loan. Okay, so it's fixed, so you don't have interest rate risk. So the other loans that they call student that you see out there, there's a parent loan that's federal. That has nothing, your child's not on it at all. You use it to pay for college, but it's your loan. And then there's private student loans, and you're always going to be co-signing, or somebody's going to be co-signing. So if you're going to take out debt, this is definitely the first place to start. And as long as you submit that FAFSA, which is a huge reason you should submit it, your child is automatically eligible. You don't need to qualify, okay? So that's a big planning opportunity. A lot of people will spend down their savings and they get to junior year and say, yikes, I wish I could get those loans from freshman and sophomore year, and you can't. Okay. Okay. 4-year cash flow.
2 minutes left.
Okay. Let me just touch on this. You want to look at this net cost, right? You want to look at what the college is giving you. What discounts are you getting? So in this example, you got $323 and the college gives almost $100,000. So you're getting down to $224. Then you want to look at what you can afford. I call it college pre-approval. This example, the family figured this out ahead of time and they can afford $115,000 over the 4 years. So that goes into the mix. Then you've got a funding gap here of still $109,000. And that's when you bring in loans, you might bring in home equity. There's different things you can bring in here. But I really, really encourage you to look at this purchase in this way. And if you're going to take out more debt, really look at the 10-year, possible 25-year amount, okay? So we've gone through this process at a high level. Emily's going to put in the chat this link. If this is something you want to learn more about and you want to do it through my coaching and support, I have a course. And if you click on that URL, it gives you some more information about the course, and I would love to have you. She's also going to put a link in there so you can download my slides, okay? So click on those, and that'll open up tabs, and you'll have it for later. We don't have time to touch on this. I am doing a webinar on this probably later this month. So if you download my slides, I'll have you on my list and you'll get the webinar invite. We'll go into this because you notice on a few slides, there's some major changes coming up for the 2023-2024 school year. So you'll get this slide when you download it and you can read through it. We're running out of time. So I circle back and I tell you that I use this process for my son. It worked very well. He had two schools. One was much more expensive, 60,000. We had the cash flow. We set the expectations for him. It was an easy conversation. He went to the other school that he really liked that was a better fit for us financially. And here they are. They live in Seattle. They came back to this area, even though they went to school far away. They're thriving. They're supporting themselves. And you guys can do this too. All of you can do this. And I love this graphic because it's just your kid. You'll be waving goodbye to them before you know it, leaving them at their dorm. So really try and enjoy this time and do the planning. Don't drift through this process because it's a really, really expensive process to drift through. So I hope that I've opened up your eyes to a few things. Are there any questions I can answer here? Let me see here. What about extenuating financial items like medical bills from COVID treatment or cancer? Okay, excellent question. Basically, on the CSS profile, they ask you about medical expenses. I would still reach out to them and tell them more and give them documentation. On the FAFSA, you will reach out to the colleges. That's an item where you're going to reach out to the colleges. Anything that's a strain on cash flow, you want them to understand, and you want them, this is not a time to be shy about your finances. You want to be really clear with them about, we have these expenses, because that means you don't have the money to pay for college, and you want them to take that into account. And they can do what's called exercise professional judgment. We call it PJ in the industry, right? And they know they can do this, and they'll adjust your EFC, which then could give you potentially some need-based eligibility. How different is aid if going to college abroad, say England? So first of all, it will be much cheaper of a sticker price because Europe isn't like us. It isn't this crazy expensive deal. There are schools overseas where you can submit the FAFSA, a lot of them. And so you can get the direct student loan that I talked about. And there's what's called a plus loan. It's a parent federal loan. So it's not a loan that your kids take out. It's a loan that one of the parents takes out. So you are eligible for those. And then what about Canada? Somebody put in, Canada's the same way. So with Canada, if you have dual citizenship, though, which some people do here, then that's if you have dual citizenship, then you're going to pay much, much less, right? But if you don't have dual citizenship, you can submit the FAFSA. And certain schools, Canadian schools, have merit aid for international students. That's a school by school basis. So you might be able to get merit aid. Most schools in Europe, I haven't noticed that, but the sticker price is so much lower. And you can, like I said, you can submit the FAFSA. So then if they're a school that accepts it, and most of them do, they're accredited and everything. And you can get the parent loan and the direct federal loan if you're overseas at a school. Anything else? We're 3 minutes over, but I'm happy if there's any other questions. So definitely click on the link to download my slides. I also send out blog posts and everything. I provide a lot of support to people on my list. So I encourage you to download my slides, and you'll find out about my webinar. Anything else? All right, doesn't Emily, do you see anybody typing, Emily?
I don't right now. There's still a lot of people here though, so if anybody has a
Yeah, I
question.
know. Yeah, if anybody wants to ask a question, now's the time. You're welcome, Michelle. how do they calculate merit aid with Running Start? They look at grades and test scores. So in a normal world, when, you know, when all, like I said, when all kids had test scores, that's they looked at test scores. But Running Start, with Running Start, you have grades, right? Your child's still considered a high school student because they haven't graduated. So Running Start is just part of the mix for merit aid. They know that that's college level coursework, so that'll be part of the rigor. But yeah, they look at it in the GPA and the grades just like the other classes. It'll be taken into account. You're welcome. Everybody's saying thank you, which I appreciate. All right. Well, I don't see anything else coming up, Emily. Just a lot of thank yous, which is nice because I can't see everybody. So it's so nice to know that humans are actually out there.
I'm going to go ahead and stop the recording.
Okay.